Welcome to the ultimate guide to early investing, from 401k to 10% growth. In this video, you will learn a simple, prioritized path to build wealth early and efficiently. We will use a smooth sequence: emergency fund first, then tax-advantaged accounts, and finally flexible growth and a taxable brokerage. Along the way, we will discuss custodians, index funds, and common mistakes to avoid. Let us begin with an overview of what we will cover. Here is our agenda: why starting early matters, the 4-step financial hierarchy, emergency funds, maximizing your 401k including rollovers, Roth versus traditional IRA considerations, taxable brokerage strategies for flexible growth, choosing a reliable custodian, using target date funds, and common pitfalls to avoid. We will also include a couple of quick quizzes to cement key ideas. Now, let us move to why starting early is a superpower. Starting early is powerful because compounding works best with time. Small, consistent contributions made in your 20s or early 30s can grow dramatically by retirement. The key insight is not timing the market, but time in the market. With that foundation, let us transition to a simple financial hierarchy that organizes your priorities. Here is the high-level roadmap. First, build an emergency fund in a high-yield savings account equal to 3 to 6 months of living expenses. Second, maximize tax advantages by contributing to your employer 401k at least up to the full match, and then prioritize contributions to a Roth IRA up to the annual limit. Third, for flexible growth, invest through a taxable brokerage account using broadly diversified index funds. Fourth, keep costs low and avoid unnecessary complexity. Next, we will show how to build that emergency fund efficiently. To build your emergency fund, first total your essential monthly expenses and multiply by 3 to 6 to set a target. Next, open a high-yield savings account from an insured institution and confirm the rate and any limits. Automate contributions from each paycheck until you reach the target. Do not invest these funds. They are for emergencies and should remain liquid and safe. If you need to use them, replenish afterward and review the amount annually. Now that your safety net is in place, we will move into maximizing tax-advantaged accounts. Inside your 401k, your first goal is to contribute enough to capture the entire employer match, because that match effectively doubles the match dollars immediately. If you leave an employer, avoid early withdrawal penalties and taxes by rolling the account into an IRA, either traditional or Roth, depending on your tax situation. Within the plan, choose low-cost, diversified index funds when available. With that foundation, we can now examine the Roth versus traditional IRA decision. Here we compare Roth and traditional IRAs. Roth contributions are made with after-tax dollars, but qualified withdrawals in retirement are tax-free. Roth accounts. Roth accounts are often compelling for young earners who anticipate higher income and higher tax brackets later. Traditional IRA contributions may be deductible up front, giving a current tax break, but withdrawals are taxed in retirement and required minimum distributions apply. Your choice depends on current and expected future tax brackets, as well as plan eligibility. Next, we will organize key features in a simple table, and note that you should verify current IRS limits. This table summarizes account types and tax timing. A 401k can be pre-tax or Roth, depending on your plan, and features employer matching and higher limits compared with IRAs. Roth IRA contributions are after-tax and grow tax-free with qualified withdrawals. Traditional IRA contributions may be deductible now, with taxes due on withdrawals later. A taxable brokerage has no contribution limits and offers flexibility, but dividends and realized gains are taxable along the way. Always verify current IRS limits for contributions and eligibility, as these change over time. Moving on, let us discuss flexible growth and a taxable brokerage. A taxable brokerage is ideal for goals that require flexibility. Historically, broad stock markets have returned around the high single digits annually over long periods, but that figure is not guaranteed in any specific year. A practical approach is buying and holding total market index funds, such as VT or VTSAX, and prioritizing long holding periods to qualify for long-term capital gains rates. Automate contributions and avoid frequent trading to reduce taxes and friction. Next, we will choose a trustworthy platform to house your investments. When selecting a platform, prefer established custodians such as Vanguard, Fidelity, or Schwab, which provide low-cost index funds and reliable service. Avoid newer speculation-oriented apps that encourage frequent trading or complex products. For simplicity, a single target date retirement fund can provide age-appropriate diversification that adjusts risk over time. Now, let us visualize your entire plan in a mind map and then test your understanding with a quick quiz. This mind map places early investing strategy at the center. One branch is safety, emphasizing a high-yield savings account with 3 to 6 months of expenses. Another branch is tax-advantaged accounts, including contributing to the 401k at least up to the full match, and prioritizing Roth IRA contributions up to the annual limit. A third branch is flexible growth, using a taxable brokerage, focusing on total market index funds and long holding periods. The platform branch highlights choosing Vanguard, Fidelity, or Schwab. The behavior branch reinforces automation, low fees, and avoiding speculation. Next, we will check your understanding with a quiz. Question: in what order should a young investor generally prioritize their dollars? Options: a taxable brokerage first, then emergency fund, then 401k match. B. Emergency fund, 401k up to match, Roth IRA, then taxable brokerage. C. Individual stocks, options trading, then Roth IRA. D. 401k, beyond the match first, then emergency fund. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. You start with an emergency fund for safety, then contribute to your 401k to capture the full employer match, then prioritize Roth IRA contributions up to the annual limit, and finally direct additional funds into a taxable brokerage account. Next, we will visualize compounding over time with a simple timeline, and then discuss tax treatment of gains. This timeline illustrates how steady monthly contributions accumulate over 30 years. Although annual returns vary and include down years, the overall trajectory tends to trend upward over decades due to compounding. The key takeaway is that time in the market, plus consistency, drives outcomes more than attempting to time short-term moves. Now, let us clarify capital gains taxes in a quick knowledge check. Question: what is the primary tax advantage of holding investments in a taxable brokerage for more than 1 year? Options: A. Dividends become tax-free after 1 year. B. Short-term capital gains rates apply. C. Long-term capital gains rates may apply, which are often lower. D. Employer match is added to your taxable account. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. In a taxable brokerage, holding a position for more than 1 year may qualify the gain for long-term capital gains tax rates, which are often lower than short-term rates. Dividends do not become entirely tax-free after 1 year, and there is no employer match in a taxable account. Next, we will reinforce a simple asset mix with a pie chart prompt, and then cover common pitfalls to avoid. This pie chart shows a simple illustrative starting allocation: 60% U.S. total market, 30% international total market, and 10% bonds or cash. Actual allocations should reflect risk tolerance and time horizon. A target date retirement fund automatically adjusts this mix toward bonds as you age. Now, let us address common mistakes and how to avoid them. Common pitfalls include chasing hot stocks or attempting to time the market, paying high fees for complex products, overtrading influenced by gamified interfaces, ignoring the tax impact of short-term gains, and neglecting the emergency fund, which can force selling at inopportune times. Instead, focus on a diversified, low-cost, long-term plan. Next, we will summarize the most important takeaways as key points. These are the key takeaways. Time in the market beats timing the market. Follow the hierarchy of emergency fund, 401k match, Roth IRA, and then taxable investing. Use broad, low-cost index funds and automate contributions. Hold long-term for tax efficiency and compounding. Choose reliable custodians and avoid speculative platforms. Now, let us include a brief disclaimer and then wrap up. Disclaimer: this video is for educational purposes only and does not constitute financial, tax, or legal advice. Investing involves risk, including possible loss of principal. Always do your own research and consider consulting a licensed financial professional who understands your personal situation. To conclude, we will provide a concise summary. In summary, start early to benefit from compounding. Follow the priority sequence of building an emergency fund, contributing to your 401k for the full match, funding a Roth IRA, and then investing in a taxable brokerage. Keep investments simple and low cost, automate contributions, and remain consistent over time. Choose established custodians and avoid speculation. Finally, let us close with a thank you and a call to action. Thank you for watching. If this video helped, please like, share, and subscribe for more practical guides. Share your questions, progress, and next financial goals in the comments. Your engagement helps others find and learn from this content.